banking cohort, if you like, in the West finds that they've got a problem. I mean, they're too used to running the market up and down to generate enormous trading profits, and quite happily run fairly large short positions in the process. But now they can't cover their positions. And we're seeing this very dramatically in the price of silver, more so than in gold, where there is actually greater liquidity. But I think that's the background really to what is going on in both gold and silver. And the fact that silver is outperforming gold really dramatically is a reflection of the lack of liquidity relative to gold in the silver market.
Welcome to today's financial market recap. We're focusing on the recent remarkable trends in the gold market, driven by a confluence of economic uncertainties and banking instabilities. Let's dissect the crucial elements shaping today's investment landscape. Gold prices have continued to set new records, recently marking a significant run of all-time highs. This surge reflects a complex interplay of market dynamics, including investor behavior and macroeconomic factors. The spotlight on gold is intensified by recent geopolitical tensions and economic policies, which have pushed more investors towards this traditional safe haven. Central banks, especially from emerging economies, have been aggressively purchasing gold, moving away from greenbacks, which has further buoyed gold prices. Moreover, the demand for physical gold, particularly in key markets like China and India, remains robust. This sustained physical demand, alongside speculative trading activities, suggests a strong undercurrent that could continue to support high gold prices in the short term. However, it's important to note that such price levels are also sensitive to shifts in policy by major central banks like the Federal Reserve, which could influence investor sentiment and speculative activities in the commodities market. Lastly, it's clear that the current environment is fraught with financial uncertainties, including ongoing conflicts and a precarious banking sector, which in 2023 drove a significant increase in gold and silver demand. These factors collectively create a potent mix that could either further drive up gold prices or lead to corrections, depending on how geopolitical and economic scenarios unfold. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button so you do not miss our daily recaps. Enjoy the episode.
Gold-silver ratio, I'm looking at my screen, of 73 times. That is not pricing it as money, but it does respond with gold as if it was a junior form of money. So, it hasn't gone totally. What is so interesting, I find, is the complete lack of interest in Western capital markets about silver and gold, while at the same time there is enormous demand, obviously building up in Asia and particularly China. Silver has, if you like, an additional factor driving it. One is that India is now expanding its economy quite rapidly in the direction of photovoltaic cells and similar, if you like, environmental manufacturing activities. And I'm sure that major Indian corporations like Reliance Industries have been cleaning out COMEX vaults. I mean, the amount of silver that's been stood for delivery is really quite dramatic. Particularly when you bear in mind that the futures market is not meant to be a delivery market at all. I mean, the only reason that you have a delivery facility is basically to notionally tie the future to the price on expiry. So that is interesting. But I think for both gold and silver, it's worth understanding the position of the Chinese. Just look at Chinese households. Chinese households save roughly 35% of their income. That is huge. It is enormous. And given the size of the economy, which in US dollar terms is roughly $18.3 trillion in GDP, 35% of that is about $6 trillion. Now, $6 trillion of savings, where does it go? Well, if you look at property, that's yesterday's story. After Evergrande went bust and all the rest of it, all those problems. And you can see that the amount of land now being developed, it's just fallen off a cliff. There is no demand for property in China now, residential property. So that's gone out of the window. Stock market, well, for the last 3 years, it's been a pretty poor deal. It's gone down. It's gone up this year, really, since about January the 1st. It's up about 8-9%, something like that. But, if you're an investor, if you're a saver in China, you've probably got in your mind the fact that you've lost a lot of money, or you would have lost a lot of money if you'd bought equities over the last 3 years. So it's not going there either. We do know where it's going. It's actually going on bank deposit. And there is a difference between our banks and Chinese banks. The Chinese banks are effectively backed directly by the state. So, a Chinese individual feels really quite comfortable having 3-year, what they call certificates of deposit, giving them an income of 3% over 3 years, 3% annually over 3 years. So that is where they put it. Now, this is effectively risk-averse stashing of savings. All these banks, coincidentally, offer gold savings accounts. So if you've got a minimum of, say, 500 or 600 yuan, which is roughly $80, then you can open one of these accounts. Now, I don't know whether these big banks run their gold accounts on a fractional reserve basis, or whether they actually back it properly. But I would have thought that they're not going to get themselves into the same position, if you like, as their bullion bank cousins in the West. So, demand from customers switching from ordinary deposits into bank deposits, I would have thought, goes, pretty directly via the bank into gold. They also have apps in China. You've got these apps, and you can buy and sell gold on an app. I mean, we've got that sort of thing over here as well, but they've got it in China. Don't forget it. And from what I understand, very much unlike us, where we actually have very little interest in coins and bars. You have to be a bit die-hard to be interested. In China, they're queuing around the block to buy gold, jewelry and small bars and items like that. The big stores are literally selling out every day. So there is huge, huge demand. And this is not necessarily reflected in the withdrawals from the Shanghai Gold Exchange, because the big banks, in accumulating gold on behalf of their customers, don't take it out of the Shanghai vaulting system. It remains in the vaulting system, so it's not effectively delivered. So there's a huge, great iceberg, if you like, of gold. We only see the tip of it in the form of deliveries actually accumulating on behalf of the Chinese people in the vaults. Now, to give you an idea as to what 35%, in other words, 6 trillion of savings actually buys in terms of gold, is the equivalent of about 75,000 tons of gold. Now, obviously there isn't the gold available, but now you can begin to see why the Chinese, who traditionally have always regarded gold and silver as money, are buying both gold and silver. And the problem with silver is that it is a very illiquid market. It is consumed. It is taken out of the vaults. If you look at the numbers from the Silver Institute, you see that the reserves, if you like, that are being drawn down are in, according to them, in the LBMA's vaulting system and also in COMEX.
India imports more silver in 4 months than in all of 2023. India's silver imports in the first 4 months of the year have already surpassed the total for all of 2023 on rising demand from the solar panel industry and as investors bet on an outperformance versus gold. Government and industry officials told told Reuters. Increased imports by the world's biggest silver consumer could support global prices, which are trading near their highest level in more than a decade. India imported a record metric tons of silver during January to April, up from 455 tons in the same period a year ago, said a government official who declined to be named as he was not authorized to talk to the media. India imported a total of tons of silver last year. Almost half of this year's imports have come from the United Arab Emirates to take advantage of lower import duty, said an importer based at Ahmedabad in Gujarat. India generally imposes a 15% import duty on silver. However, the Comprehensive Economic Partnership Agreement signed between India and the UAE in 2022 allows private traders to import silver through the India International Bullion Exchange, paying 9% duty and an extra 3% in value added tax. Now we'll show you more excerpts of the interview. Remember to watch the video to the end so you don't miss out any insights. Let's get back into the episode.
It's been drummed into Americans' heads that gold is no longer part of the monetary system. The dollar has replaced it. And it's also been driven into the heads of everybody who would call themselves allies of America. We now accept the dollar is money, and gold is a pet rock or whatever. The gold standard was a barbaric relic, as Keynes put it, before all this. It does actually leave American citizens very, very exposed, I'm afraid, because it is propaganda, no more than that. The legal position is quite simple. It has always been that gold is money and the rest is credit. And it doesn't matter what propaganda you've had drummed into your head over the last 50 years. The law is the law. It's as simple as that. And the reason it works as a law is twofold. Firstly, it's behind everybody else's legal position. So it is truly international. It takes the nationality out of credit. The second reason behind this is that it is always credit which circulates, not money itself. Money is there to secure the value of credit. And if you detach credit from money, then it starts losing value. And you can see this reflected, if you like, in the move of the dollar, where from $35 an ounce in 1971 to currently nearly 2,400. Put it the other way around, and what you're looking at is the dollar has lost over 98.5% of its purchasing power in 50 years, measured in gold. And gold is the standard. This is not Bitcoin, which is going up and up and up and up because it's being driven by speculative demand. This is real money. Its purchasing power is relatively constant. It's relatively constant in the sense that it can maybe double or halve against certain commodities over a period of time. But that's very different from losing 98.5% of its value. Very, very different. We're going to go back to understanding that gold is money. And the other thing I would mention is that I do think that the US government has got itself into a virtually impossible position, because not only does it state that it's got 8,132 tons of gold in its vaults, but also it acts as custodian for earmarked gold for other nations. Now, there was a fellow called, I'm trying to think, Frank Venerosa, who did some research into the leasing of gold in the 1990s, and he concluded that anything between 10 and 14,000 tons of gold. The 14,000 tons was roughly half the total central bank declared ownership of gold. Up to half of that was out on lease. In other words, there were two owners of it. Now, I'm pretty sure that, certainly for the last 20 years, the Bank of England, when it has leased gold, has retained it in its vaults rather than let it go out of its control. In other words, leased gold then becomes an asset which someone can then use, if you like, as a basis for extending credit. But it's never delivered. This is the important point. So, it's a sham in a sense. But the Bank of England, I think, has been getting away with it. I don't think it's the case, however, with the US Treasury. And we saw evidence that this might be a problem when Germany just wanted a small part of her gold.
What do you think of Alasdair's take? Is he spot on? Will the banks get short squeezed, or will they manage to push gold and silver prices back down as usual? Are you even bullish at these prices? Post in the comment section your honest opinion and watch this video right here because it's a perfect fit for you. I see you on the other side.